This is going to be a short New Year's video. I had a great question from a subscriber today. He asked about using gold stocks as a proxy for gold in the portfolios that I have suggested in my videos. I suspected that they would not be, since there are other factors that impact gold mine performance other than changes in the price of gold. But just to be sure, I ran some numbers. For those of you who are not familiar with the term correlation coefficient, its meaning is pretty simple. It is the percent of variability in one variable that can be explained by movements in another variable. Thus, a 90% correlation between two variables x and y means that 90% of the movement in variable y can be attributed to movements in variable x, and 10% of the movements are due to other factors. Most of you are familiar with this chart that I've put together, showing the correlation of various assets versus the amount of time that the assets are held without rebalancing. This view of correlation is a unique contribution of mine, as far as I know, because it shows that the longer gold is held in a portfolio that contains stocks without rebalancing, the more effective gold is at insuring against adverse price action in the stock market. You can see this by looking at the red curve in the chart. Over short term, gold and stocks are fairly uncorrelated, which is why most financial people recommend against gold in a portfolio. They'd rather hold bonds in a portfolio because although they are somewhat correlated with stock performance, the variability of bonds year to year is not nearly as wild as that of gold. Contrast this to what happens with assets that are held for 5 years without rebalancing. The negative correlation between stocks and gold grows to about minus 70% compared to the nearly 50% positive correlation between stocks and bonds. I have shown in prior videos how important this can be. A long-term oriented investor can do better diversifying their portfolio with gold than with bonds. A person is well advised to hold some gold in a portfolio of stocks and only rebalance very gradually. This is in stark contrast to the rules that we are taught by the finance industry. I added another curve here for your consideration, and that is the correlation between the XAU, which is an index of gold miners, and gold itself. What I found interesting about this curve is that out to about a year of holding time, the XAU is only about 50 to 60% correlated with the price of gold. This means that about 50 to 60% of the moves in the XAU can be explained by changes in the price of gold, and about 40 to 50% of the performance of the XAU is due to other factors, such as cost of production, movements of speculative money, etc. Out past 5 years or so, the XAU becomes about 75% correlated with gold itself, meaning that only about 25% of the variability in the XAU is due to other factors. But notice something here that's very interesting. Over long time periods, bonds in the S&P 500 are nearly as highly correlated as gold and the XAU. Now focus your attention on the blue curve. This represents the correlation between the S&P 500 stock index and the XAU. Notice that up to holding times of about a year, the XAU is positively correlated with the S&P 500. Over longer term horizons, the correlation decreases, but the XAU never becomes as negatively correlated with the S&P 500 as gold is. When we take into account that the XAU is much more volatile than gold itself, and also consider that it is not as negatively correlated against the S&P 500 as gold is, one can only conclude that gold is a much more efficient holding in a mixed portfolio of assets. I hope this adequately answers my subscriber's question and provides the rest of you with some useful insights. As always, please feel free to comment in the comment section, and if you like the video, please indicate so by hitting the like button. Thanks.